Because no matter how big of an investment size you have, there are options. What's up everyone, Conrad Neufeld here, and today we're talking about real estate investing versus the stock market. After my last video, I had a few people reach out to me and say, hey, which is better? And just like in the case when people asked me about how Denmark could have a 0% mortgage, I'm more than happy to answer. I'm even going to save you from clicking to the end of the video to discover the answer, because the answer actually depends on a few things that are unique to you. Mainly, how much do you have to invest? What's your risk tolerance? How much time do you have to manage your investments, and what is your debt load? Depending on the answers to those questions, one may be better than the other. For instance, one of the common things that I see is low net worth individuals trying to replicate or imitate the investments or investment strategies of high net worth individuals. And while logically that might make sense, it can also be dangerous, because sometimes those investment strategies only work when you reached a certain net worth. So let's go through that together. And even if a category doesn't seem like it applies to you, I'd still encourage you to watch all the way through, because some of the things that we may reference may apply to you either now or in the future. This one can be a bit tricky because there aren't a whole lot of options. On the real estate side, for example, there are virtually none, unless you're considering wholesaling, which I'm not a big advocate of. Wholesaling is a bit beyond the scope of this video, but I'm mostly against it because it can be extremely time consuming and, depending on which region you're doing it in, may be illegal if you don't have the proper real estate licenses. So, to keep this relatively simple, because we already have a lot to cover, that really just leaves stocks for this category. But there are a couple other factors that we need to consider before investing our 5K. The first thing to consider though is, what is your debt situation like? It can be super easy to get caught up in the excitement of stock investing, especially when, as of recently, it's being covered in the media a lot. But if you're sitting on high interest debts like credit cards or lines of credit, then what's actually in your best interest is paying those debts off. That's because it's unlikely that you'll be able to earn a consistent enough return to be able to outpace the interest costs that those debts are incurring. You'll just simply get a higher rate of return on your money by paying off those debts. Assuming you've got all your debts in check though, the next thing to consider is your growth goals. One of the biggest temptations that I see is people trying to go for the quick, big kill. And what they end up doing is putting themselves into situations of high reward, but also of high risk. If you're trying to grow your investment and you do have less than $5,000 to invest, you should be looking for more consistent, slower growing stocks. If someone with a high net worth were to play a risky investment and lose, there's still a very good chance that they're going to be able to recover from that investment. You, on the other hand, if you've invested your entire $5,000, are probably going to have to restart from scratch. And that would suck. Stocks are also a great investment because they are significantly more liquid than other types of investments, particularly when you're comparing them against real estate investments. The liquidity of a stock means how fast you can get out of that given investment, how fast can you turn it back into cash should you need to get out, which can be extremely important if you have some unforeseen life events come up, like a medical bill that would require some immediate money to take care of. Stocks are great for this. You can get in and out relatively quickly, usually at the click of a button. And if you invest in slow growing, more consistent stocks, you won't have to necessarily worry about what the price of those investments will be should you need to liquidate those investments sooner than you were intending. Around $15,000 to investors where things start to get a little bit trickier, for a good reason, because it now means you have more options available to you. Now when I say you have $15,000 to invest, I do not mean your mom's $15,000. If you yourself do not have the money to invest, it is generally a bad idea to borrow from friends and family, or to borrow on debts that you can't afford to repay in the event that you lose your investment. Every investment, no matter how safe it may seem, comes with known risks, but more importantly may come with some unknown risks. And if you end up on the bad side of an investment, it really sucks to lose all of your money. But it sucks even more to strain the relationships that you have with friends and family over something like money. I say that because I am approached all the time by people in this investment range looking to flip houses. And while flipping houses can generate a profit when done correctly, it is generally far too risky than you can afford at this stage of investment, for a few reasons. Just like we mentioned before, real estate is a non-liquid investment. And even if your intention is to do a quick flip, that could still mean several months before it turns around and you're out of that investment. That can leave you really exposed with no cash reserves. Not only that, investment properties require 20% down, meaning that in this investment stage, the property that you're likely renovating is your own primary residence. And not that there's anything necessarily bad with that, it just means that your life may be uncomfortable in the time that you're transitioning in this house. And even then, in the case that the primary residence is the investment property that you are renovating, you're still likely using your entire cash, your entire investment, for the purposes of that down payment and closing costs. meaning you have no cash available to do any of the renovations. So any of the labor that you can't do yourself and the materials are likely going on lines of credit or credit cards. Not only does that eat into your profits, but it also puts you further at risk should the investment not work out quite like you intended. So for this investment size, stocks still end up being the best investment vehicle to grow your net worth, with one exception, and that's house hacking. The basic concept of house hacking is buying a house for yourself, but bringing in renters to live with you such that all or part of the mortgage and housing costs are paid by these rental proceeds. If you're willing to live with renters, bonus points if you can convince friends or family to rent off of you, then you can use that $15,000 as your down payment and your closing cost to purchase a home. This will also simultaneously reduce your monthly cash outflows because you're no longer going to have monthly housing costs, and that in turn will allow you to invest more in the future. At this investment stage, your highest returning investments may be limited less by how much you have to invest and more so by how much that investment size matches up with other factors, particularly how much time do you have to invest and your location. In economics, there is thought to be two types of competition: perfect competition and imperfect competition. Perfect competition doesn't actually exist in the real world, because for perfect competition to exist, both buyers and sellers would have to have equal and similar amounts of knowledge, which no market does. So it's just to which degree is the market that you're playing in imperfect, meaning how much of an advantage does information play a role in making sure that you get a good deal. Real estate, when compared to the stock market, is very much an imperfect competition. The buyers and sellers in a real estate transaction do not share equal or similar amounts of knowledge, because every single real estate transaction brings with it its own unique qualities. That means if you're looking to spend the least amount of time possible to find an investment or monitor that investment after you've become involved in it, then the stock market is likely the way to go. Good real estate is never on autopilot, despite what these online gurus might tell you. But let's say time isn't your limiting factor. In that case, location still may be. As mentioned before, investment properties usually require about 20% down, meaning in this investment range, depending on where you live, it can severely limit the quality of property that you can purchase. For instance, if you're buying in some place like Fredericton, where the average home price is $198,000, you may be able to still find some hidden gems to bring a whole lot of value to it. But if you're buying in some place like Vancouver, where the average home price is a whopping $1,036,000, you're likely not getting a quality investment property at this level of investment. But let's say now that you had enough to invest such that both quality opportunities existed on the stock market and in real estate. Which would perform better? Stock markets generally have two types of returns. Appreciation of the value of the stock, meaning that the value of the stock increases in price over time, hopefully, and dividends, also known as the yield. These are company profits that are paid out to its investors, expressed as a percentage of the value of the shares. Now, because your return in the stock market can go up or down and fluctuate over time, we look to the long-term average of the S&P 500 index as a good comparison tool. And we find that, generally speaking, stocks return an average of about 7.96% per year. That means if I were to take $250,000 and invest it in the stock market today and receive that annual return of 7.96%, after 10 years, I'd have an estimated $537,735. But let's compare that to how we'd fare if we took that same investment size and put it into real estate. Like stocks, real estate can also see appreciation, meaning that over time your properties can and likely will grow in value. And when real estate is done right, it can also give you positive cash flow throughout the life of the building, as long as your rents are covering the property expenses and the mortgage. Let's take that same $250,000, for instance, and buy a rental property with it. Now, the complexities of the math behind this go beyond the scope of this video, but as a nationally award-winning mortgage broker, you can either take my word for it, or you can run your own numbers. If you want to do that, some of the assumptions that went into the scenario I made is that we're buying a multifamily unit for $1.6 million, using the minimum down payment to 15%, leveraging the rest as a default insured mortgage, capping the amortization at 35 years, a competitive 10-year fixed rate of 2%, and utilizing a cap rate of 6%. So with all of that considered, what we'd expect to see with our real estate investment is a profit from our cash flow alone of $393,076. On top of that, though, the property value likely increased with inflation, let's say a modest 2% for the purposes of this video, although I certainly believe an inflationary period is in our future. That would mean that after 10 years, the property would actually be worth $1,950,391. And since the rents you've been receiving have also gone on to reduce the mortgage loan sitting on the property, Your actual equity in the property, if you were to sell, is $834,711. That brings our total 10-year return to $1,227,787. There is a reason that people can get really passionate about real estate. There is some monster returns out there. But just like I mentioned before, a multifamily purchase like this would have taken many months to put together. And anyone who's ever owned a rental property before knows that along the way there were many headaches that needed to be solved. By the time you've hit this investment size of over $250,000, your investment goals start to shift focus a bit. It's not just about making a return anymore, although that's obviously still part of it, but it's also about making sure that taxes aren't bleeding your investment returns and making sure that your portfolio is diversified amongst real estate and the stock market. In America, you have something us Canadians don't have, which is the 1031 exchange, essentially allowing you to perpetually defer your capital gains taxes as you roll your liquidated investments into new real estate assets. And as a Canadian, I am super jealous of that. One of the things us Canadians can do, however, just like our American friends, is to depreciate the value of our asset on paper. Essentially, by doing that, we reduce the amount of income that we claim in a year, thereby reducing our income tax and increasing our capital gains tax when we go to liquidate our investments. So it's not a tax avoidance strategy, but it's a tax deferral strategy, allowing us to make the most of our investment returns while we hold the investment. Real estate is also a great investment because it allows us to write off some expenses and write off the interest that is charged on the mortgage of our own investment portfolio. This allows us to get the most that we possibly can out of our real estate investments. By the time you hit this investment range, I would be shocked if your accountant wasn't already leveraging every single stock tax incentive that exists. And if you're not, you should definitely look into it. In America, you have your IRA or your 401k, and in Canada, we have RRSPs and TFSAs. So with all of this said and done, I hope that the biggest takeaway that you get from this isn't that when it comes to stock investing in real estate that one is better than the other. It's just that they're different, and that depending on where you are in your investment life cycle, one may be better than the other. If you've made it this far, thank you so much for watching. Please consider subscribing and hitting the bell notification so that you're alerted when new videos come out. It really goes a long way in supporting a new channel like this.